Welcome to the Investopoly podcast. Our goal is to share easy to understand, evidence based, holistic insights to help you master the game of building wealth. My name's Campbell Wallace. I'll be filling in for Stuart today. And what I'd like to talk to you about today is the super death benefit tax, and in particular, how to minimize or even eliminate the 17% super death benefit tax. Now, to paint some context, in Australia, we don't currently have a inheritance tax like some other countries do, or a traditional inheritance tax. So, in the UK, they do as one example. But that being said, the idea has been popping up, which might be concerning some people in the political conversations, especially with the government recently discussing it at the Economic Reform Summit in August. So it is in the conversation, but here's the thing. At the moment, we don't have an inheritance tax, but there is one sneaky tax that often catches people out, and that is the superannuation death benefit tax. So let me start by painting the picture and giving you an idea of why this tax exists and how it works. So look, the superannuation system is designed primarily to help Australians save for their own retirement, not necessarily to pass on wealth to the next generation. So concessional contributions to super, so these can be employer super guarantee payments, salary sacrificing or personal deductible contributions, they are taxed at 15% when they go into super. So there's a full tax deduction personally, but they're taxed at 15% when they go into super, or 30% for individuals with a adjusted taxable income of more than $250,000. But across the board, for most people, that's far less than their marginal tax rate. So overall, you're getting a good tax deduction, even if you account for the tax that's paid on the contributions into super. So the government introduced the death benefit tax to effectively claw back some of those concessions if super is ultimately passed down as inheritance rather than used for retirement. So in simple terms, if your kids inherit super, the ATO takes a slice back on the way through. So how does it work? So under super rules, the taxable component of your super balance is taxed at 17% when it's paid as a death benefit to a non-dependent. So there are important definitions there. So the taxable component is basically the part of your super fund that's made up of those concessional contributions that I mentioned before, and also the earnings on those contributions. So I think employer contributions, salary sacrificing, and deductible contributions to super. And if you ever want to find out exactly what the breakdown of your super fund is for these taxable and tax-free components, you can always see it on your super statement, or if you log into your online portal to look at your super, it should have it broken down there, the taxable and tax-free components for you. So the question is, who counts as a non-dependent? So pretty much a non-dependent is anyone who isn't your spouse, a child under 18, or someone that you have an interdependency relationship with, or someone who's financially dependent on you. So for most people, their super is made up mostly, or from what I see, I don't know the exact data on this, but certainly from what we see, the super fund's made up mostly of concessional contributions. That just sort of makes sense. Most people, a lot of people will do non-concessional contributions in the later years, but really for most of their working life, the majority of contributions to super are their employer contributions, their salary sacrificing, and deductible super contributions. So really what this means is that a big chunk of their balances are sitting in taxable component. And I'm sure if you go and look at your balance on your super statement, it's going to show a very large portion, certainly the majority, that is in the taxable component. So when a spouse dies, the surviving spouse usually inherits the super tax-free because they're considered a dependent. But in the instances when the surviving spouse then eventually passes away, the super often goes to an adult child. So if you think about it, the average age of death is at least 60 or 70 years old. It's upwards, it's higher than that, the mean, but most people, it's at least 60 or 70 years old, and most of the time people have adult children by that point. So that's where the 17% tax kicks in, and it can potentially erode hundreds of thousands of dollars from their inheritance. So the question is, what can you do about that? Now, there's a pretty widely known strategy called a recontribution strategy. It's just a typical recontribution strategy, which a lot of people are aware of. And how this works is once you retire, so either you're 60 and retired or 65, whether you're working or not, and you can access super, you withdraw the money from super. It's tax-free at that age, so there's no tax on withdrawing the money from super. And you then recontribute the money back in as a non-concessional contribution. So it's effectively then changing. So when a non-concessional contribution goes back in, that's a tax-free component. So you're pulling out taxable component and you're putting it back in. So you're effectively just converting taxable component to tax-free component. Currently, the non-concessional contribution cap is 120,000 per person per year. Now, there's also an arrangement called the bring forward rule, where you can contribute up to 360,000 in 1 year, and your balance has got to be below 1.76 million, mind you. That's because you can't be contributing more to push you over the transfer balance cap. So you've got to be there's a balance limit there. But the bring forward arrangement allows you to bring forward 2 future years. So you're putting in 360,000. So that's 120 for this year, 120 for next year, 120 for the year after that. And then obviously next year you can't make any more non-concessional contributions for the following 2 years because you've brought forward those years. So this strategy is good, but it has its limitations and it's not perfect because one of the problems is you can't choose which component to withdraw. So if you're withdrawing from the super fund, you have to withdraw equally in line with the proportions of taxable and tax-free component. So say, for example, your super fund is 90% taxable and 10% tax-free. Well, you'd be withdrawing the 10% of what you're withdrawing is the tax-free and you'd be putting it back in as tax-free. So that's not achieving any benefit for that 10% portion. But however, it's still effective for the vast majority of people, as I say, because most people have the majority of their super fund in the taxable component. And the other key limiting factor with this traditional recontribution strategy is that every time you then do it, subsequently the effectiveness of it drops. So you do the initial one, it'll have quite a lot of effectiveness, but then the next time your super fund will be diluted in terms of the taxable and tax-free component. And if you do it again, it's going to be further diluted the next time. So let me give you an example here of what I'm saying. So if you started just simply with $1 million in super and it's all taxable component, well, if you recontributed 360,000, the balance of your super fund would then turn into 36% tax-free and 64% taxable. And then after 2 years, you did the same thing again, your balance would then go to 41% tax-free and 59% taxable. And if you do it again and again, you understand the law of percentages is that the benefit gained in how much you're converting gets smaller and smaller and smaller every time because you're recontributing more tax-free out and putting tax-free back in. And in fact, it would actually take, by my calculations, about 27 years of repeating this process to almost fully convert your balance to tax-free. Now, the issue here is that's well beyond the 15-year window that most people actually have available to them. So you can access your super at 60 if you're retired, but then you can no longer do non-concessional contributions after the age of 75. So there's only a 15-year window here in reality, and for some people it might be shorter, it might be 65 if they're still working, that they can access super. But really there's a 15-year window here available, and doing it 27 years to do this particular example is not going to cut it. So as you can see, whilst the traditional recontribution strategy, it works and it has benefit, and it certainly would reduce the amount of super death benefit tax applied to an individual, it's not ideal. Now, here's the alternative, and this is what I call a smarter recontribution strategy. So a far more effective variation is to use 2 super funds, 2 super accounts, which could be with the same fund or could be different super funds. It doesn't really matter. But why do you do this? Well, because the taxable and the tax-free split is measured at an account level, at a super account level, not across all of your super, which is an interesting loophole. So this means that you can keep the taxable and the tax-free components separate by having 2 super accounts. So let's look at that example I was using before about $1 million in super, all taxable component. So instead, you set up the second super fund, you pull out 360,000 and you recontribute 360,000 using the bring forward rule and non-concessional contribution into the second super account. Now, across both funds in the first year, you'll still have the same situation as before. You'll have 36% tax-free, 64% taxable. But here's the difference then. In future years, you then go on to withdraw only taxable funds and recontribute it into the tax-free fund. And that's where the effectiveness comes in. By isolating components, you don't dilute the mix each time you withdraw and recontribute. So if you were to repeat this process every 3 years, so using the bring forward arrangement, you have to wait 2 subsequent years, then you do it again. If you did it under this scenario, in around 9 years, you could convert the entire balance of this $1 million portfolio to tax-free, completely wiping out any potential death benefit tax. And based off a balance of $1 million, well, that's a tax saving for your beneficiaries of your inheritance of around $170,000. Now, this benefit, it comes at a cost though. And so the question is, well, what are the costs? So of course there is a cost of running two super funds, but it's a pretty small cost and it's usually pretty minimal in my experience. So most funds, most super funds, be it industry, retail, wrap super funds, most of them pretty much charge a percentage-based administration fee. So that's, percentage of the balance plus a flat account keeping fee. So really, the only difference that we're working with here, if the balance is, you've got one super fund with 1 million or two with 500,000, the percentage-based administration fees are the same. Really, the difference here is just the account keeping fee across both. And so, what does that look like? So, typically, here's some examples: Australian Super account keeping fee of $52 per annum. Uni Supers is $96 per annum. Net Wealth or Hub24, for an example of a wrap super fund, is about $240 per annum. So, even at the very higher end, if you're using a wrap super fund, paying $240 a year for less than a decade, because you'll only have the two super funds running for the period of time that you're converting this super fund. So only less than a decade is a pretty small cost compared to the saving of $170,000 in tax. Now, obviously, it's not a benefit to you, it's a benefit to your beneficiaries. So you don't get the tax benefit here by doing this. But, for a lot of people, I think that's quite important to them, the wealth that they pass on to the next generation. And if they have to, incur a small cost in these account keeping fees in order to get that benefit for their children, I think most people would understand that. So really, you could do the calculations yourself. You could look at, well, what are the account keeping fees of having a second super fund of my choice that I'm going to do? And based off my balance, how long is it going to take? How many years will it take to convert my balance? And you can pretty much look at it like that and just go, well, here's the annual account keeping fee times by 9 years. Well, that's what I'm going to have to pay. And then you could look at, well, what's the tax benefit in terms of my inheritance? And you can weigh up that cost benefit yourself. So let me give you a real life worked example of how this sort of plays out. And let me just, before I do, I'll just say, look, this strategy, it comes with its complexity. It comes with its effort. There's administration involved. There's work that needs to be done. If someone just wants to go a simple strategy of just drawing upon their super every year in retirement, then maybe this isn't for you. But this does come with work, and there's some things that you do in order to make it work. But just note that there's a bit of administrative work involved in implementing this strategy. So let's use an example here. Say someone retires at 60 with 1.8 million in super, and it's all taxable component. And this person, let's say they might be a surviving spouse or they're just a single person. Either way, they don't have a spouse at the moment, but they've got one adult child as their nominated beneficiary of their super fund. So if they pass away immediately, the death benefit tax would be around 306,000, which would leave from their 1.8 mil super about 1.5 mil to their adult child. So let's say this person chooses to start using the smarter recontribution strategy and they set up a second super fund in order to do this. So they've got two ways that they can go about this in terms of the actual mechanics of how it works. So the first one is they could keep their current or existing super fund in accumulation phase, so i.e. not convert it to pension phase. And every year they could withdraw what they need to live off. So say this person needs to live off 100,000, that's their retirement income that they need, plus the 120,000 that they're going to recontribute into the second super fund. Now, alternatively and more optimally, what they could also do is they could convert their existing super fund into pension phase and then every year convert 120,000 or roll 120,000 back into accumulation phase to withdraw as a lump sum. Now, why do we do this? So the benefit here is that, well, firstly, the funds in this first super fund are invested tax-free in pension phase, which is ideal. But also it's important here then that the person doesn't run the risk of exceeding their lifetime transfer balance cap. So what is the lifetime transfer balance cap? So at the moment, for people that commence retirement today or convert their super to pension today, it's $2 million. You've probably heard the $2 million, but this is a lifetime amount. So that's dictated to you that over your lifetime then, 2 million is how much you can roll into pension phase. So then the reason that if you put your existing super fund in pension phase, the reason we roll back 120,000 from pension to accumulation, that then brings it down, 120,000 is reduced off their lifetime transfer balance cap, and then it's put back in. So otherwise, if you had it in pension phase and you put it back in, you'd run the risk of exceeding that lifetime transfer balance cap. A little bit technical at this point, but I hope that makes sense. And then as for the second super fund, well, that can be in pension phase constantly. However, it needs to be refreshed each year as technically you cannot make a contribution to a pension account. So pension accounts are locked in. You can't contribute to them like you can to an accumulation fund. But what you can do is what's called a pension refresh. So every year that you'll have that pension phase, the second super funds in pension phase, to put money into it, you need to momentarily roll it back into accumulation phase, contribute the 120,000, and then roll it back into pension phase with that new 120,000 in it. So that's called a pension refresh. Now, I'm just realizing in the way that I'm wording this that I've, spoken about doing 120,000, doing this process every year. So 120,000 every year. In reality, to minimize the administrative burden, and there is a little bit of work here and paperwork, it'd just be easy to do this strategy every 3 years with the 360,000 via using the bring forward rule. So I've run some numbers, some calculations for this particular example. So if we assume a 7% return, so performance of the super fund per annum, if we then take into account inflation, so let's use 2.5% per annum as an inflation figure, and if we also factor in some expected increases to the contributions cap, because naturally the contributions cap is indexed and it has gone up. It was previously 110,000 and before that it was 100,000. It's now 120,000, so it is indexed and it does go up over time. So based off the historical track record of that, I've projected ahead what I think that cap will increase to. Under these assumptions, they could convert their entire balance within 11 years. And so by then, they would have more than $2 million, all tax-free and all in pension phase, and their child would inherit the full amount, saving over $340,000 in death benefit tax. Now, what's the cost? So the cost I spoke about before of having the second super fund running for that period of time, well, the cost is around $1,056, roughly $1,000 in account keeping fees across those 11 years. So to save $340,000 for their adult child in their super death benefit tax, it came at a cost of about $1,000. That's a pretty good return, I'd think. And just a couple of little items here, small tangents that I just want to make, and a few things I just want to point out. So the first one is reversionary pensions. So whilst this strictly isn't really about the super death benefits tax, it's worth highlighting that super pensions should generally be set up, we think, as reversionary pensions. So a reversionary pension automatically transfers to your spouse when you pass away. So it can only work under that arrangement to your spouse. And the benefit of doing this is it allows you to keep the super inside the tax-free pension super system. And if the pension isn't reversionary, the alternative is the super would instead need to be paid out to your spouse into their personal name, potentially losing some of the tax advantages of being in pension phase, but also potentially of being invested in super. So where there is a spouse there, most people, and they're going into pension phase, they should certainly consider having a reversionary pension so it automatically flicks that pension over to their spouse in the event of death. And the other little item I just wanted to note was about the binding death benefit nominations. So a few weeks ago, Stuart wrote a blog about testamentary trusts. And if you want your beneficiaries to benefit from a testamentary trust, the surviving spouse needs to nominate your legal personal representative as your binding death benefit nomination of your super fund. It's getting a bit technical here, but that sort of wording, that technical name, legal personal representative, effectively nominates the trustee of your estate for your super funds. So it diverts the super funds into your estate because technically super assets aren't estate assets technically, but you can sort of circumnavigate them to go into your estate and therefore be dictated by the instructions of your will by nominating the legal personal representative as the binding death benefit nomination of your super fund. Now, this doesn't really allow you to get around the paying to a non-dependent, and getting around the death benefit tax. Ultimately, if the super benefits go through an estate into a testamentary trust, it's really who is the final beneficiary of it is what dictates whether it's a dependent or non-dependent. So, just by flowing it through an estate and then it ends up going to a adult child doesn't mean that you're not paying super death benefit tax. You still do. It's dictated by who those super funds eventually are received by as the beneficiary. So in wrapping things up here and looping back to the main point about this smarter recontribution strategy, what I'll say is that, super is one of the most tax-effective structures available during your lifetime, and the tax concessions that you get by contributing money concessionally to super are really, really good. But, without a strategy in place, super could also become a very ineffective tax structure in terms of passing on wealth to the next generation. So that's just something that people need to be aware of. They need to be conscious of the taxable component in their super fund, and then conscious of who is receiving their benefits upon their death, and are they a non-dependent? Because there could potentially be a lot of tax to be paid. However, through some smart planning here, as I've outlined, there's certainly some strategies that you can go about by reducing that tax in your estate. Okay, so I've probably got time for one or two listener questions that I'm just going to jump into at the end here. So first one is from Dean. Now, Dean's written a very long email, so I'm going to summarize things, but Dean is 38 and his partner is 40. Dean has two young kids and he's a small business owner. And Dean originally he's got two companies. So he had his first company, which he was running, and then he mentioned that he went and bought another company, another business in the same industry. I don't know what industry. And this second company that he bought, he said it didn't work out too well, didn't go as smoothly as anticipated, and he then sold that business. So he's now left in a position where he's got his original business and company. So he's got one company entity, he's got a second company, and that company entity has actually been left open for the time being. It's not really a trading entity anymore, but there's just a vendor vehicle finance loan in there, which means that he has to keep that company open, but it's going to get wound up in time. So in that second company, he's got about $80,000 in cash, and in the first main company of his, he's got about $400,000 in cash in retained earnings. Now, outside of this, in terms of assets and liabilities, they own their home. Dean owns the home. It's worth about 1.1 mil, mortgage of 300,000. They've then got this investment property, which is a commercial property, which was purchased for the purpose of the business that he's running. Purchased for about 700,000, loans about 500,000. They've got a share portfolio, which is about 370,000, but I understand there's some gearing there because he mentions drawing an investment loan to fund that share portfolio. So I'm not quite sure what the balance of it is, but the share portfolio is worth 370,000, and then combined super fund is worth about 150,000. So the main point of Dean's question here is he's wanting to understand what should he do about that 400,000 of cash of retained earnings in the company, and what's the most tax effective way to pay it out of the company. He mentions that he's paying dividends, but he also mentions PAYG payments, salary and wages from the company. But effectively, he's in this position, which we see quite a bit, is that people end up retaining, and I've seen some really large amounts of retained earnings in cash inside companies because people don't want to pay out the dividends and pay the tax on them on the way through. So this is a common situation here, Dean. Now, we generally think that it's a bit of a problem. You don't want to be building up large retained earnings cash inside a trading company, inside a business, and you also don't want to be going and doing personal investing inside that company and keeping it in that entity. There's an asset protection risk there. We think, the assets held within the business could be at risk, therefore. So it's far better to try and get that money out of the business, get it into a personal name or personal entity, and then you can also then be more long-term and strategic in terms of your investing, because most people, they just retain the earnings in cash inside a company and don't go investing it. So there's an opportunity cost there in having 400,000 in Dean's example, but I've seen millions in retained earning in cash in a business which isn't working effectively for you and not being invested. So what can you do here? So I'm going to make the assumption, Dean, that the company, the main company where there's income producing from it, the shares of that company are owned either by you, just by you, or maybe with you and your wife. So I'm based off the information you've given, I think that's who the shareholders are in that company, and therefore that's who you've been paying dividends to. Now, you see there's a limitation there when people set up the structure in this way, in that, once people are getting up in the top marginal tax brackets or even sort of higher tax brackets, you're very limited and it's very set in stone who the shareholders are, and then dividends have to be paid in line with who those shareholders are. So something perhaps, and I think you definitely need to get some advice from an accountant here, Dean, but something that can be done is you look at selling those shares. So instead of you individually being the shareholders, you can sell the shares. Now, you could move them to, for example, a trust. And this is probably what you would choose to do, but there is implications in doing this. So, you sell the shares from your personal name to a family trust. What does that do? Well, then the trust then owns the shares in the company. Then the trust is a flexible entity. So from there, you have the ability from year to year to choose who to distribute what amounts of income to. So it's got full flexibility for you and your wife. You could then also make distributions to a corporate beneficiary. What's the benefit in doing that? Well, then a corporate beneficiary caps the tax rate. It's an investment company. It's a personal investment company, caps the tax rate at 30%. Small business entity, you would be paying 25%. So there's a top-up tax, but it's only 5% that would need to be paid to flow it through. But you see there's going to be good benefit then in paying dividends into a trust, having flexibility to distribute to you and your wife, potentially other family members as well, and then also potentially an investment company. So that's going to be a more effective vehicle to allow those dividends to flow out of the company and get those retained retained earnings out of there, and then you can go and invest them. The implications here, well, this is a capital event. So selling or changing the ownership of those shares is a capital event, comes with capital gains tax. So we have been through this exercise with a few clients where you've got to weigh up the cost in doing this. So, I mean, firstly, you're probably going to have to pay for a business valuation. So, because we need to understand what is the value of these shares that in the company. So there's that. There's probably paying for a business valuation, but that's not too big a thing. That's a couple of $1,000s, say. But really, then it's the capital gains here. And you need to weigh up, well, what's going to be the cost in doing that in order to then get the benefit of transferring those shares into a trust, perhaps. So that's for you to weigh up. But what I will say, Dean, is that there are some really good small business tax concessions that are offered to small businesses, particularly in regards to the sale of businesses, which you should have a look at. So I'm not going to go through all of them now because there's quite a few. But yeah, the small business concessions, which could really help you minimize that capital gain by selling the shares in that company. So there's some things that you might be able to do there and if they significantly reduce the capital to then enable you, and it wouldn't be too burdensome to transfer the shares into the trust, I think that could be an opportunity to explore. Now, Dean also asked a question about, how can I use these retained funds? Could I loan them, loan them to myself or to another structure without triggering concerns from the ATO? Dean, it seems as though, what have you done here? There's some things that you've done in terms of moving money around with these retained earnings in the past. You wouldn't want to do that very much more. In fact, I would recommend that you don't do that. That raises concerns. Pretty much money needs to stay in an entity unless it's paid out or it's loaned or some sort of arrangement, but money can't just be moved in and out of entities without implications in this example, is what I'll say. And then in terms of what to do with future cash flow, well, if this strategy that I'm recommending or not recommending, but I'm just proposing, I guess, if that works and that's something that can work for you, well, then you've got really good flexibility in terms of cash flow from the company. You've then got the ability to be every year flexible in how much you can distribute from the trust to you and your wife and other potential family members, and then also to an investment company. And then that allows you that ability to then, with that investment company, there's no asset protection risk. It's separated. The money's flowed out of the company, and then that's your investment company, and you can go and do some investing in that company. And then Dean's final query is around that investment property, the commercial property. So from what I'm understanding here, he bought that in his personal name. So he's sort of asking, could I move this into another type of structure or entity so that I don't have $48,000 of rent in my name currently? It's kind of pretty restrictive doing that, Dean. You're paying stamp duty on the way through, capital gains on the way through, legal fees on the way through. So it's usually pretty cost prohibitive for most people. We get this question a lot. Oh, could I move this into a trust or a company or change names? It comes with costs, and it's usually, it's pretty restrictive in doing that. So I think probably the answer is not. But however, it seems as though, with a loan balance of $550,000, then the commercial property of $700,000, and then looking at the interest rate there that you've told me what that loan is, the property would be negatively geared. So in current state, I think that works. Even though it's a commercial property, and they obviously tend to be higher yielding, the commercial properties, that would still be negatively geared. And I think you're getting negative gearing benefits in your own name. So in reality, you're not getting the full $48,000 of rent in your own name. You are, but it's negatively geared against the cost, the interest on that loan. So you're getting some negative gearing benefit there. So I don't see the huge concern. All I'd say there is that will change over time as the rent goes up and as interest rates come down. That'll start to become, because it's a commercial property which are high yielding, that'll start to become more cash flow positive, and then you'll start really paying tax on that property by having it in your own name. So I'd certainly look at, trying to extend the interest only period on the loan to retain that loan balance, rather than paying it down and getting it to cash flow positive sooner. So I think, without knowing the specifics of the property, but I think it's going to be restrictive in changing the ownership structure, and I think it's okay how it is. I'd just make sure you retain that investment debt, deductible debt, as much as possible for that property. Okay, look at that. I only got through one question, so I've run out of time now. So until next time, bye for now.
Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel, and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it, because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I, I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.